Ann, what are you telling your clients to do now that we've seen a very strong bounce in the market, but still plenty of uncertainty as to where the economic and earnings picture goes for this market?
Thanks, Sarah, for having me on. And you're right. It is a very uncertain picture ahead of us. And I think finding a bottom is a process, not a price. That's what we would tell our investors too. And so it's to stay focused on their long-term objectives and stay focused on their allocation and not to diverge too much from that, not to try to trade around too much from that. And our active managers are doing the same. They're staying focused on strongest companies to come out of this.
Steve, we mentioned earlier some of the key Fed programs, the key government programs that have been helping markets. Do you think, though, that we've run out of steam based on just those, that we now need to see some more fundamental good news in terms of economic data, which obviously this morning was pretty dire?
Well, I think that seems to be the case. I mean, as far as I'm concerned, I stated in a piece earlier this week that the Fed went to 11. A lot of people didn't really think they had it in them to go as far as they did. Perhaps the only shoe left to drop is actively intervening in the equity markets. I don't know that they have the capacity to do so. But ultimately, it's up to the companies to deliver. And as Ann just mentioned, a lot of people are looking at the type of stuff that will act well in this type of environment, but I fear that's getting to be a crowded trade. So ultimately, companies have to deliver. There's got to be cash flow. There's got to be earnings. And I don't know that the Fed has it in them to bring that to the table for a lot of people.
Josh, how much of this move do you see as being Fed-driven?
I'm going to say that the Fed went to 11 because they are not trying to stop a recession. They already know a recession is a foregone conclusion. I think what the Fed did is to work directly with the Treasury and literally try to head off social unrest. That is where this could have been heading if they hadn't acted as quickly and as decisively as they did. So I'm not like a Fed fan. I don't wave the pom-poms. I recognize that there are people who have legitimate complaints about the Fed. But in this particular case, I think they had to do what they had to do. So how much of the stock market rally can you attribute to that?
That's what I'm getting at.
I'm not sure I can quantify it. But, I got to tell you, we would be in a very different place if they were still negotiating what to do or giving speeches where one person said something different than the other. The Fed acted as one unit. The market liked it. Is it 16% of the move, 50% of the move? I couldn't tell you.
Josh, one thing that Stephen Scher, the CFO of Goldman Sachs, said to me earlier today was that some of those actions meant that Q1 was about technicals, saw huge gapping of various markets in terms of bid and asks, and Q2 is going to be more about fundamentals. Yet earlier we were talking about the level of momentum in certain stocks, certain sectors. Do you think that momentum needs to break down and actually this should be now a fundamentals-driven stock pickers market?
I like that idea. I don't think the fundamentals are good, but I think balance sheet will be important. Peter Bookvar has been talking about that on our air, and I think that's the right take. People want to know mostly from companies, not answers to questions they don't have, like when will we get back to normal. It's a total waste of time to ask that on a conference call. CEO doesn't know. But what they do know is, what does your revolver look like? What does your credit facility look like? Is it fully committed? What's your cash position? What have you done to reduce cash burn? Like, that is what people want to hear on this season's conference call. So, yes, I suppose fundamentals are more important at this point than necessarily price action.
Let's get back to Bob Pisani.
But look at what happened.
Sorry, go ahead, sir.
I was just going to say, look what happened, and Ann, I'll ask you this today. You know, Governor Cuomo talked. That's what investors are paying attention to. It still seems like, you know, the curve flattening, the health numbers, the measures that New York and other cities and states are putting in place when it comes to widespread testing and developments on the vaccine front and on treatment, whether it's antivirals or antibodies, that's the kind of data it feels like the market is watching right now, even less so than the earnings and the economics. Ann, does that change? Do you agree with that?
I do agree with that, Sarah. I think but it relates back to what Josh was talking about. It's because the fundamentals at the end of the day do matter, and investors care about when do we get back to normalization in terms of earnings and cash flow. But that's what the focus is. And when you see when can we get the economy restarted and how do we do that, that's when you have a line of sight as to when normalization starts to happen. And I do think this is a unique opportunity for active managers, stock selectors who don't have to own every name in index. And so these are the times where we can focus on those fundamentals.